The world is swept up in an AI revival. An economic bubble is defined as a specific cycle where the price of an asset rapidly escalates, soaring far beyond any intrinsic or fundamental value. This surge is not driven by sound financial principles, but by speculative demand and what is known as irrational exuberance. And it inevitably culminates in a sharp, painful contraction or crash. To explain this recurring pattern in financial history, economist Hyman Minsky identified 5 distinct stages that a bubble typically follows. 1. Displacement. 2. Boom. 3. Euphoria. 4. Profit-taking. And finally 5. Panic. The current AI boom is a textbook example of a classic economic bubble, a cycle defined by asset prices soaring far beyond their fundamental value due to speculative demand and irrational exuberance. According to economist Hyman Minsky's 5-stage model, the AI phenomenon has progressed through a displacement, the arrival of powerful generative AI, a boom, soaring prices and media hype, and into a state of euphoria, where extreme valuations are normalized by the greater fool theory. The parallels to the historic dotcom bubble of the late 1990s are striking. Just as investors then poured money into any company with a com suffix, ignoring poor financials, today's market is valuing AI companies like OpenAI and Anthropic in the hundreds of billions based on future potential rather than proven profits. A cautionary tale from the dot-com era, the company eToys saw its stock price rocket to $78 despite massive losses, only to collapse to 28 cents after failing to become profitable. This pattern has led institutions like the Bank of England to warn that current AI-related valuations are as stretched as they were at the peak of the dot-com bubble. However, viewing this as a simple replay of history would be a mistake, as there are crucial distinctions. The most significant difference is the financial health of the core players. The dot-com bubble was led by unprofitable startups. In stark contrast, today's AI revolution is driven by the Magnificent Seven, immensely profitable giants like Microsoft and Nvidia, whose strong cash flows provide a stable foundation for the boom. Furthermore, the sheer scale of investment is arguably far greater, with hundreds of billions being spent annually and valuations dwarfing those of the internet era. Because of these differences, a potential market correction might not resemble the total wipeout seen in 2001. With financially robust foundational companies at its center, a burst bubble is more likely to create a great chasm, separating the sustainable innovators from the purely speculative ventures in a massive sorting of the wheat from the chaff. The boom, the second stage of the AI bubble, is characterized by soaring prices and a speculative frenzy, fueled by a powerful, transformative narrative. The 2022 launch of ChatGPT acted as the primary catalyst, unleashing a deluge of media coverage that painted a picture of an imminent technological revolution. Headlines relentlessly amplified AI's potential to solve humanity's greatest challenges, from curing diseases to replacing entire workforces. This created a potent feedback loop. Intense media hype fueled investor excitement, which in turn generated more media coverage, further stoking the flames of enthusiasm and often overshadowing the technology's practical limitations. This environment gave rise to a prevailing sentiment of irrational exuberance, where investors and executives became convinced that the old rules of economics no longer apply. This "it's different this time" fallacy, a classic feature of financial bubbles, was acknowledged even by those at the center of the boom. OpenAI CEO Sam Altman admitted that investors are overexcited, while other influential figures like Ray Dalio and Torsten Slot issued direct warnings of a speculative bubble. Even Mark Zuckerberg, one of the biggest spenders on AI, conceded that a market correction may be on the horizon, revealing a deep-seated awareness of the market's precariousness. The market impact of this hype has been profound and has created significant systemic risk. The Magnificent Seven tech stocks have become the sole engine of the S&P 500, accounting for 55% of its gains since late 2022. This concentration has overheated the market, with 40% of the index's companies trading at over 10 times their sales. The speculative nature of the boom is perfectly encapsulated by OpenAI's projected $500 billion valuation, which hinges on a highly optimistic and unproven model of converting a fraction of its 800 million weekly free users into paying subscribers. While leaders like OpenAI's chairman Brett Taylor draw parallels to the dotcom era, suggesting that transformative giants can emerge from the hype, the atmosphere remains tense. The line between visionary investment and dangerous speculation grows increasingly blurred, leaving the critical question of how long this euphoric state can last before the harsh realities of profitability bring the party to an end. As the AI boom reaches its zenith, clear warning signs of a speculative bubble are becoming impossible to ignore, with the initial euphoria giving way to a harsher reality. The most alarming of these signals is the revelation of a widespread failure to generate returns. A landmark MIT study found that a staggering 95% of corporate AI initiatives have failed to produce a measurable return on investment. This is compounded by the rise of work slop, superficial AI-generated content that actually drains productivity, as identified by Harvard and Stanford researchers. If the billions being invested are not yielding tangible profits, the entire economic justification for the boom begins to crumble. Alongside the economic failures, significant technical and performance issues are emerging. The much-hyped release of GPT-5 in August 2025 was met with widespread disappointment, as it showed diminishing returns and failed basic tests, prompting over 5,000 users to petition for a return to the older GPT-4 model. This highlights a fundamental capability-reliability gap, where AI systems continue to make small but costly errors that require significant human oversight, undermining their supposed efficiency. In a particularly sobering study, even experienced software developers were found to be 20% slower when using AI tools, directly contradicting the narrative of immediate productivity gains. These foundational problems are exacerbated by immense financial pressures. The race to build the necessary infrastructure is being fueled by enormous amounts of debt, with Morgan Stanley projecting that big tech will spend $3 trillion on data centers over just 3 years. This reliance on massive loans is reminiscent of the risky credit that preceded both the 2008 financial crisis and the telecom crash of the early 2000s. The parallel to the dot-com era's fiber optic overbuild, where 85 to 95% of the laid cable was left unused as dark fiber, is particularly apt. Today's colossal data center projects like OpenAI's Stargate represent a similar, enormous capital bet on future demand that may never materialize. Finally, the market itself is beginning to show signs of cooling. Meta recently announced a freeze on AI-related hiring, and venture capitalists are estimating that startup funding could dry up by early 2027, setting a potential timeline for the end of the speculative frenzy. These developments signal that the honeymoon phase is over. The market is now beginning the painful process of differentiating between sustainable innovation and speculative hype, shifting the central question from if the bubble will burst to what exactly will be the final trigger. Financial bubbles are fundamentally driven by human psychology, and the AI boom is no exception. It is fueled by a potent combination of cognitive biases and emotional responses that compel otherwise intelligent institutions and investors to act irrationally, pouring vast sums of money into a sector despite mounting evidence of its failure to produce a return on investment. One of the most powerful forces at play is herd behavior, amplified by an intense fear of missing out, FOMO. When investors see prominent tech leaders and competitors rushing into AI, it creates an overwhelming pressure to follow suit, lest they be left behind in the next wave of innovation. This fear is magnified by narratives of a global AI arms race, particularly between the US and China, which adds a sense of national urgency. Social media acts as an accelerator for this trend, rapidly spreading optimistic sentiment and enabling coordinated investment movements, similar to the meme stock craze. This is compounded by internal biases like overconfidence, where executives and investors overestimate their own abilities, convincing themselves that their specific AI strategy will succeed where the vast majority have failed. This is often coupled with an illusion of control over the unpredictable path of technological progress. The powerful and emotionally resonant story of AI's revolutionary potential becomes far more persuasive than the complex, messy reality of its implementation. Furthermore, principles like loss aversion, where the pain of a loss feels stronger than an equivalent gain, lead to the sunk cost fallacy. Companies that have already invested heavily in failing AI initiatives are psychologically reluctant to abandon them, choosing instead to justify further investment to avoid admitting a loss. Finally, the greater fool theory is thriving. Many investors, while aware of the inflated valuations, participate with the belief that they can always sell their assets to a greater fool at an even higher price before the inevitable crash. Together, these psychological forces create a powerful gravitational pull towards speculation, making it nearly impossible for rational analysis to prevail until the bubble finally bursts.